everyone, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we get started, standard disclaimer, nothing here is investing advice. Do your own due diligence. And today we are once again joined by the founder of Peter Grandich and Company and one of the most respected commentators in the commodities space, Mr. Peter Grandich. It's great to have you back on the show.
Good to be back with you.
Now, I want to touch on two important points you made on your blog recently that I think it's very important for investors to understand. You said, one, failure is the norm in the junior resource business. Doesn't mean there's any dishonesty, just means despite best intentions, not everyone finds a future mine. And number two, perhaps more importantly, you have to be both financially and mentally prepared to lose part or all of your capital. So how does one financially and mentally prepare to lose part or all of their capital?
Well, since I'm an expert on losing as well as winning, I can tell you that part of it comes from the fact that I think we become too believers too fast in whatever we're thinking about or end up buying. And we don't think of, or many times if it's from an advisory standpoint, we're not told of the downside risk. And so we take the best case scenario the moment we're engaged in that position. And as you noted, for every 10 juniors out there, and not saying anything that they're not trying to find something or doing anything underhanded, but only 1 or 2 out of 10 is going to find, develop, sell, or bring into production a mine. So if you just simply buy and hold forever, about 8 out of 10 times it's not going to work for you. So that's an important part. Financially, when it comes from advice from people, financial advisors are decent in terms of measuring people's financial risk. Where they're very weak is mental anguish. And the reason is it's other people's money. It's not their money. So they don't have the anguish if it doesn't work out. And what happens is, and take me for example, both out of the market and by the market last year turned out to be a bad year despite phenomenal predictions about what would happen. And the mental anguish led partly to depression. And so you have to understand it, as much as it sounds like you buy low and sell high, is a much, much tougher. And the junior resource market is probably one of the toughest markets because that so many just don't work out despite them trying hard. So those are the things I think you got to think about before you get, if you're just taking a flyer and buying 1,000 shares of something, that's fine. But if you're going to be active in that market, you need to be prepared mentally and financially for it.
Yeah, it makes a lot of sense. I want to talk about gold here because we're seeing a lot of chaos around the world. The war in Russia, between Russia and Ukraine, seems to be escalating. NATO and Western countries are getting more and more involved. We're seeing social unrest around the world, high inflation, central banks aggressively raising rates that could be leading to a global recession. Is this an environment where you think holding gold is perhaps more important than it's been in a long time?
Well, I personally have, from the 1600s, talked about what I believed was going to be a new mega bull market. Some still argue it's a big bear market rally, but I think it's a new bull market. And two things have made me feel that confident. The first is the paper market, which used to be dominated in London and on the Crimex, which some people call the Comex, I call it the Crimex, was notorious for shorting and taking advantage of the downside. That has lessened, A, because they finally caught people, charged them, and convicted them, so it's not a free ride anymore. And B, a lot of the paper trading has moved to the Far East, where there's a lot less of that. But the main reason for the gold bullishness is the tremendous buy-in by central banks. Jesse, I can't tell you they're not buying for a speculation. They're not buying for a trade. They're buying for a major reason, whether it's just to diversify from the U.S. dollar, the thought that the U.S. dollar has peaked, or there'll be a new currency, or a combination of all those three things. That alone is. But one of the things I used to say in the days when I was on the management side of the business, buy gold and hope it doesn't go up. And people say, well, why would I want to buy something if you don't think it's going to go up? Well, most people are heavily invested, and we saw last year, in financial assets. And most times, if financial assets do well, gold doesn't, and vice versa. So you buy it like you buy car insurance or home insurance. You don't want the home to burn, but if it does, you want something to offset it. And I find that in the U.S. steel, investors are terribly underinvested in gold. They don't even have a half of 1% in a portfolio. And that's because also, Jesse, that the financial industry in the U.S. at least treats gold like kryptonite. They don't want to speak about it. They don't want to talk about it. They'll talk about cryptocurrencies before they'll talk about gold. So I think gold is a deserving asset at all times, but now in particular, I think there's a lot of upside for it.
Yeah, and I like how you said with holding the physical metal, the hope is that it doesn't go up in that sense. Like as our friend Peter Spina says, you buy gold not to make money, you buy it to not lose money. And gold kind of stayed flat last year while the broader market fell dramatically. So in my mind, it did its job at protecting purchasing power. Not to mention it's actually gone up in a lot of other currencies. If you don't measure it in US dollars, but you measure it in other currencies, it's reached all-time highs in a lot of those. Japan, for example, the Japanese yen. If you're in Japan holding gold, you're very happy right now. So I wanted to get your thoughts on the continued push for a new green economy and leaders around the world seemingly looking to punish companies and industries that don't match their idea of green. Croatia has, in my mind, unfortunately, where I'm at, moved closer to the EU. And the EU's coming up with all sorts of schemes that you have to be carbon neutral, you have to do this, or else we're going to fine you. Is this a sustainable trend, or do you think the pendulum will eventually swing the other way?
Well, there's an old saying, don't fight City Hall. And this is a worldwide movement. It's hard to fight governments. Here in the U.S., they've seemed to totally committed to it. Everything's coming, electric cars, electric this, big solar, all that type of stuff. I don't see it unwinding. I don't see it reversing. So I think we have to get used to it. But the amazing thing is they're all putting the cart before the horse because they're all switching over. Where's the infrastructure to provide the electricity for all these cars? We have blackouts and brownouts now throughout the United States just on the current demand for electricity. And it's a joke when I say it, but it has serious implications. Our electrical grid was built by Thomas Edison. I mean, that's how old it is, and it's not coordinated. So and we can talk about it later maybe, the minerals and all that are going to be needed to make all these things, these cars and so forth, is not readily available. So I don't think it's going to get to the level as fast as they predict because of those things. But there's no doubt that the governments at least have decided, pedal to the metal, this is the way we're going.
Right. Well, let's talk about that right now then. The minerals that are needed to bring about this new green economy. Obviously, copper is a really big one. Lithium for batteries, graphite, all those things. Let me get your take on the battery metals here, because the push for the EV revolution is in full swing. As you're saying, the infrastructure isn't even there, but they are pushing for this, which means those minerals are going to be in demand. Do you think, at least in the short term, there is an opportunity in battery metals right now, or is that not an area you look at?
I don't follow it, but I think all those things, I think what people have to recognize and take a step back, and this goes back, I'm just going to be going into my 40th year around this. So I've been around the block in the metals and mining. I've seen enough ups and downs, especially downs, to last a multiple lifetimes. But I'll tell you this, what's changed dramatically for that, and it plays into a role of what you're speaking about, is for a lot of years, there's been under capital investment, not only into the minerals, but also in oil. And we used to say you could take a globe, spin it, point your finger, and wherever you land it, yeah, we can go to there. It's okay. That's not the case anymore. There's plenty of reasons to be concerned if you're a mining company to be in Latin America or South America now. We're seeing all sorts of political, economic, and social issues. We saw even in Panama where they just decided after a mine was built and all, hey, we're not asking for 2% royalty now, we want 20%. So I think mining companies are going to have a much more scale of availability where they're going to look. probably North America, even though in North America, there's some provinces in Canada and here in the U.S., California, I wouldn't want to be trying to develop a mine there. But so that is a key part of the availability of these metals. Not only is there going to be a great expansion demand for them, but their availability. And remember, these things can't be found, developed overnight. It could take 10, 15 years from discovery to the first pour or whatever, first taking out. And so I'm, whatever it is in those areas that are going to be needed for this stuff, I see a tremendous commodities bull market. Now, I don't follow the agricultural, so can't speak about soybeans or things of that nature. But a guy said recently, it's a good description. Anything you can drop and hurt your foot is a good commodity right now. And so I would remain very bullish in that and have. And one of my favorites is copper. So, that I like very much.
Right. Well, where do you see the supply demand fundamentals of copper right now? Because as you're mentioning, these mines aren't built overnight. Copper in particular, these mines from discovery of a deposit to bringing a mine online is incredibly expensive and time intensive. And the problem is a lot of these same leaders who are pushing for ESG policies for electrification of the world are also against mining of all kinds. So you end up with this strange conundrum. As you noted in a lot of South American countries, they're starting to get more socialist leaders who are wanting to nationalize mines, who are also against mining. So it creates this conundrum, setting the table for potentially a very severe supply-demand imbalance. So how do you see copper playing out in the years ahead?
Well, you had a very good interview with that gentleman, Lobo. And in fact, it was he a few years ago that I caught an interview of his about uranium. I said, wow, uranium is all the way down there? And he got me interested looking at that. And that interview you did recently was very good. He made some extremely important points, many that I concur with. In fact, I believe I posted your interview and said I concur. And really what it is this. It's the underdevelopment for years. Some of the best places have already been mined out. In South America now, if you want to look for it, you either got to go way up high of a mountain or you got to face a lot of opposition. And so and a lot of these lower grade deposits are going to require a much higher price because of all the costs. So I'm a believer, I think in as little as 12 months, but maybe it'll take longer than that. We're going to have a $5 copper price, regardless of whether there's a recession in the U.S. or what have you. And therefore, the companies that are not in those areas and are particularly high grade, and I got a prejudice because my largest holding is a company called Arizona Metals, and they're in Arizona, where I don't think I'm going to face the same issues if I'm in some South American country right now. So I think it's copper, it's other metals like that. They're all gonna see great interest, and the majors are in much better financial shape now going into this bull market than they've been in other ones where they were heavily indebted and all. So I think there's going to be a lot of M&A, some from necessity, because each company struggles, and if they come together, they'll do better. But I think there's going to be, and I think they will reach down to the junior market for anybody that's developing a significant project or projects.
Well, let's take a step back from the commodities market for a second and take a look at the broader market, because we've seen a rally so far here in 2023, surprising a lot of people, thinking we were headed a lot higher, a much bigger correction. Could this be just a dead cat bounce before the overall market plunges lower, or are good times here again? Is it time to pop the champagne and buy the S&P 500, Peter?
You sound like a member of the Don't Worry Be Happy crowd on Wall Street, where you can throw them off the top of the building and all the way down. They say the same thing. Hey, so far so good. Listen, I'm not in the crash camp, okay? I was extremely bearish, and I still am. I personally wouldn't want to own General Equities for any substantial reason at this point in time. But I don't believe there's a 50% crash and it's going to happen overnight. It could be, but I'm not in that camp. What I think you're seeing is the main reason why I, in 2021, urged people to get out. Many didn't want to. Not only has there been a more younger, less experienced investor who was used to driving a one-way street, but the professional advisory community was quite young. In fact, In the U.S., almost 2/3 were in the business 15 years or less. So they really only experienced one financial crisis, and it didn't last that long. And so they have this thought that they talk about, it always comes back. I mean, you can watch a certain network here, which is always putting up the happy people. And that's basically the underlying theme. It always comes back. Don't worry. In fact, the typical financial planning done in the U.S. uses what's called the 4% rule. Don't worry. This is how you can retire. Goes up. You take out what you need, and the market always goes back up. Last year, that didn't work. And I'm afraid even if it doesn't go down, but it just stays flat, these people now are going to have a much more difficult time living out their retirement plan. So I call it a dead count bounce, call it just a natural reaction of people who are used to always driving down a one-way street. But I think it's going to be very difficult to move forward for a lot of things. And I'll just name them, and then if you want to discuss them, it's fine. We don't have to. Everybody knows the debt crisis. That is atrociously bad, 30-something trillion. The CBO just came out with a report that they expect over the next 10 years there'll be another 19 trillion added onto that. Then we have the problem with the politicians just started talking about entitlements, Social Security, Medicare, Medicaid. But the unknown one that isn't being spoken about, and Wall Street won't because they make a living out of this, that's the coming retirement crisis, Jesse. And I wouldn't be surprised it may be in Canada and some other places as well. I know it's in Japan. We have 75% of Americans working paycheck to paycheck. So not only can they not buy a lot of discretionary stuff, which tells me that since we're a 70% consumer demand GDP, we're not going to have a booming economy, but how are they saving for retirement? They're not. The studies show very few people are saved right. And those people will be faced either working much longer and or going to the government to help us. And now we have millions of people coming in, illegally, whatever you want to call it, who are not going to really work up the food chain line. They're going to be down at the bottom rung looking for the government to help them at a time when the government has $100 trillion of, entitlements and hard debt out there. So I find it very hard. If a stock market is still a place where businesses sell part ownerships and businesses really depend on strong economies and things, I don't see how it can do as well or anywhere near as it did previously because the game is over. They can't keep printing money and they can't stay at zero interest rates.
Well, let's go a bit deeper into that, into the retirement crisis and the debt crisis as well. And consumer debt, obviously, also at an all-time high in the U.S. Your average household is starting to take on debt for bare necessities at this point, which is certainly an alarming trend. So what is the average Joe on the street to do? Somebody who maybe doesn't have the savings and is trying to support their family. I know it's obviously not an easy question to answer, but is it a matter of tightening the belt and just saving wherever you can and trying to invest? Or how should the average person deal with this?
Well, first of all, one of the main reasons my financial planning business is way down is having this negative outlook. But I have a model that most people don't want to hear, and that is less is more. You see, our parents and grandparents, there was never warehousing. Public storage every 2 miles you drive on a major road, there's public storage, and a lot of that is people keeping their stuff there. Our homes are now 4,000 or 5,000 square feet sizes when the parents and grandparents, only the Rockefellers had those type of sizes. We got used to too much stuff. In fact, George Carlin had a wonderful routine when he used to talk about that and all. So the first thing is it's hard for people to accept is they need to take a step back or two on their lifestyle, and they don't want to hear that. The second other problem is that ability to borrow became very easy. In fact, commercials are on all the time about a guy, hey, use this credit card, you get 5% back. Meanwhile, you probably spent 95% on something you didn't need. And you made a very good point. We're now seeing the average Joe, as you like to call it, using credit card to just charge for necessities, just to put food on the table. Food banks are reporting not only a dramatic increase of people showing up, but working class people up a ladder have gone. So it's very tough. People don't want to hear those things. Wall Street will not talk about it. They really insulate themselves as if the only people that existed are the people in the top 20%. That's who they sell to, and that's all they focus on. But 80% of Americans are really, really struggling, and it's getting tougher and tougher. I see it by just what people write to me about, and how not only is it financially struggling, but we talked before, the depression and all that people are facing, and the anxiety to get by these days.
Yeah, and I think that is a potential solution, is that the less is more, as you're saying. I mean, cancel your Netflix subscription. That people have gotten used to the era of abundance, and I think in many ways for a lot of people that could be over. So it's unfortunate, but that's the reality we're facing. Let's switch back to commodities now and talk about silver and gold equities, because a lot of people I've spoken to recently seem to think they're very undervalued at the moment. So I wanted to get your view on things. Do you think there's an opportunity in the gold and silver miners here? And which do you prefer, one over the other, gold or silver miners at this time, or are both worth looking at?
So relative to just the gold and the silver price, mining shares are at one of their most historically low valuations. And as I mentioned before, in the top of the class, they're in very good financial shape. Okay. The junior market, which I experienced this, is not in very good shape because it really got hammered last year, we saw, and I got hammered with it. And this may surprise people. There are financial people that actually lose money. Don't be fooled. There are a few like me that actually lose money. But I've taken an approach. I'll tell you how I look at it. First of all, sometimes you have to find something that's special. Like right now, and I'm biased in this, but there's a company called American Pacific Mining. They did 2 deals. They made an acquisition last year that gave them part interest in a developing mine in Alaska. They have a tremendous joint venture with Rio Tinto in Montana. And just between those 2 projects, those partners, not them, are going to spend over $40 million to explore and develop. How many juniors are going to have $40 million spent on them? So then they have a couple other projects that they wholly own. So that's something that's going to give somebody a lot of shots. Remember, nothing is guaranteed and all. And it's other people's money. I'm also very interested in areas of the world. Obviously, I told you before that I'm concerned with one that I've always liked, and I've liked it for a few years, and that's Quebec. I believe that they're on the verge of a serious mergers and acquisition there. There's too many good projects that need to kind of come together and to be better off. And the first one I would just tell you is Amex Exploration. I think as soon as they have a maiden resource out, and I still think they got 5 or 6 drills going, I think they're a lead candidate. Then there's a company like Radisson Mining that just has this phenomenal high grade. They should have a new resource out. And then the third one, who is both could be a hunter or a huntee, is a company called Northern Superior Resources. They've done a few deals, and they've put themselves in the middle where I think we're going to see the first deal. The IAMGOLD, which has been a significant producer that seem to be getting their house in order again. They have a project there, the Nelligan, that's kind of been dragging their feet on. But now I think they have reasons to expedite it with their partner Vanstar Mining and Northern Superior would benefit. And then there's what happened in the junior market to know how bad it was last year. There's a company called Big Ridge Gold. They have a 600,000 ounce deposit in Quebec and a 1,000,000 ounce deposit in Newfoundland. And they're expecting a resource new out soon. They went down to a $7 million market cap. And I think only now it's 10. So there's still a lot of value in the junior market. And whether it's gold or silver or even copper or some of the other metals you talk about, I just put a chart up on my Twitter page to show how low the TSX Venture is, especially relative to where the metal prices are. And it looks like it's turning. But again, as we started to show it, this is where the most pain can come from. But they're beaten down so much, it's really hard to see them going much lower.
Could you maybe give us some insight into how you evaluate a junior mining company? Is management one of the most important factors? Is it the deposit itself, the jurisdiction? What do you look at, and what stands out to you as some of the most important factors to determine if something is investable?
My slogan, which started when I was on the management side, then I moved to the promotion side, still remains. Give me a first-class management team with a second-class project versus a second-class management team with a first-class project. I've seen a lot of good projects not get their values because management wasn't very good. And then I've seen really good management make a lot out of something that, a lot more than it might have been. So management is the first step. If you can't get past the management, remember in the junior market, they spend a lot of time they have to promote, and it's very tough now. Can I spend a minute on this, Jesse? Because it's really important.
Absolutely. Yeah.
So years ago, there were stockbrokers, we would call back then or whatever, and they were gold brokers, and they were in Canada and the US, and they built their book of business owning juniors. And they had 300, 400, 500 clients. So if you got that broker interested in your company, he put or she put a lot of those clients in. That's gone. The discount brokers, there's almost no financial advisors making a living buying and selling individual stocks because people can do it for nothing or $5 or whatever the case may be. So that was one area how the juniors were able to promote their companies that disappeared. The second thing that happened is the government overregulated them. They said you can only promote if you have stake. Well, they don't have stake. They basically have sizzle. They're trying to find the stake. So they have to struggle there. And then, since most juniors may be looking all around the world, but they trade a lot on Canadian exchanges, the U.S. brokerage firms down here made it impossible for a broker to even accept an unsolicited order. Even if it's on the OTC here, if it's not on the main NASDAQ or the exchange, they won't even allow them to take it. So it's become harder for a junior resource company to promote itself. Now they've gone to, social media, and there's people claiming they have a lot of viewers and, that nature and all. But it's challenging. And remember, they're constantly raising money. It's just a fact of life. To develop a project, you got to keep raising money. So I see that as a big difference, and why maybe, people say, why is it so underperforming? It's very, very tough. So I would just say that, as always, management's the key. Private placements, if people are credited investors, if they can afford to, and again, fit the risk, is good because many times there's a warrant involved, and the period now of only holding 4 months, but it used to be 2 years, is a way to go. But management first, then the project second, Jesse, I went a long way on that. I'm sorry, but I thought it was worth that people know that.
No, absolutely. That's great information. Now, for those who maybe don't have the time or the patience to look into and evaluate a junior mining company, but they still, believe fundamentally in precious metals, aside from holding bullion, do you think those people should be maybe more looking towards big producers or perhaps royalty and streaming companies?
Well, royalty and streaming companies are a much more conservative way for people to play. They may not get the leverage of a 5 or 10 times return, but the safety of principle is more. And again, it all depends on where you're at. I would say that if you only have a few dollars, then just buy the GDX or the GDXJ if you want to look at the juniors. It's tough now for the juniors also because there's only a few funds that buy these. So all these juniors are competing to get in front of these fund managers that manage those things and so forth and so on. But I would say that there's still people out there, advisories, it used to be newsletters, now everybody's on the net and all, that have a track record enough to justify listening to, and following. But almost everybody has a bias, Jesse. There's very few people doing it for just the sake of God, okay? Even I, who I consider myself a faithful man, I have a blog and I have some sponsors, but I tell everybody and I don't hide it from everybody. Not everybody discloses relationships and all. So sometimes you have to be careful in that. But usually most people can see through somebody or get a feeling. So if you do find those people, or sometimes it's great, you may know somebody that's had very good fortune. I just had somebody contact me who asked me about somebody that's been in the business 35 years, and he was putting together a private placement. And my line to him was, hey, not only did I listen to him when I used to be speaker at shows, but I wouldn't mind going and having a beer with him. I couldn't say that with a lot of the speakers. So if you know somebody that has good success with somebody, that's worth listening to as well. And of
So you
course,
mentioned, oh, go ahead. Yeah.
your site.
Yes, yes. Commodity culture, trying to get the best people on, such as yourself, to provide information, unbiased information. Although you say we all have a bias, this show's all about sharing knowledge in the space and trying to help people out. And hey, I do sponsored interviews too, and I disclose it. So, I have a bias as well in that sense. So you spoke about it earlier in this interview, and you talked about it last time we chatted, uranium, that you were very bullish on the space. How do you feel about uranium here in 2023? And do you think it's still undervalued at this point for those new to the sector? Do you think this is a good place to be entering, or do you think we might see a further correction and a bigger opportunity to get in at cheaper prices later? What's your view of the uranium space right now?
Well, I don't know how the world, and I'll be long gone, but I don't know how the world gets to the predictions that they're talking about of electrical demand by 2040 and 2050 without nuclear energy being a significant part of it. I will tell you the biggest change. Here in the U.S., if you talk to a politician 10 or 20 years ago, say, hey, you'd like to build a nuclear plant in your state? No, we don't want any of that. Now that politician, please, could you come and build a nuclear plant? Because it has to be part of it. I mean, the recognition is that they're passing laws here, they're raising money on the federal level and all. And it's just the only way it's going to go forward. In terms of it from an investment standpoint, the initial run-in was the easiest, like when we went back, because they were so beaten up. Like I said, when Lobo did this interview 3 years ago, I looked at it. Uranium was down, in the teens, and Cameco, which to me is the bellwether for uranium, was at $8 a share. That was, it's hindsight, but it was easier then. I don't think there's an explosion up. I know the internet, one of the negatives of the internet and Twitter, even though I'm on it now and all that kind of stuff, is people's expectations now have been shortened dramatically. They're expecting far too much. They intraday talk about it, let alone. It takes time most times, usually longer than what we originally expected. I think it's going to be a grind up. It's just going to work its way higher. More people realize they get involved and all. There's not that many producers that you can buy. There aren't. And then the juniors is going to be where they're at and all. I mean, I own one, Kraken Energy. They've got great projects. They put a first-class management team together. But at the end, the only thing that matters is what happens at the end of that drill bit. Because remember, anything that's discovered now, it's going to take a few years to get out there. It's not going to come out there and all. So I would be more selective now, but I have no fear in my mind. And that's why the Sprott ETF is, if you just want to take the safest, the uranium price has to go higher. I've always said it has to get to $75 or higher before there's any real concern of taking profits or anything. That's my own personal view.
Yeah, completely agree. And it's interesting what you say about social media. People do, they're watching the day-to-day price being posted, the spot price of uranium, and either, cheering it on or being depressed about it. And I think that's going a bit too far. Not only that, but I think a lot of investors are looking back at the last uranium bull run where there was quite a sharp rise to the upside pre-Fukushima disaster and thinking we're going to get a similar parabolic move, that history is going to repeat itself. But I've spoken to some other people who share your sentiment that we're going to see a slower grind and perhaps a longer, more protracted bull market than last time. Well, thank you so much for joining us, Peter. Before I let you go, could you let us know a little bit about your blog and anywhere else you'd like to direct people online?
Well, there's a blog at Peter Grandich, Grandich, petergrandich.com. And then I've gone back on Twitter. I went off when all the political stuff was happening and I didn't like what they were doing. And now we learned, thanks to us, that they were doing all the things that we feared. So I only went back on at the end of December. And I find myself now like those people intraday because I'm sitting at the computer and all that. But it's at Peter Grandich. And those are the two places. I have separately a financial planning business, but it's just for people in the U.S. But I'm also putting my toes back into metals and mining. And like I said, I have a blog. I have sponsors. But those sponsors allow me to not have to charge anybody anything, and it doesn't force anybody. They don't have to buy those companies in order to see what I'm saying and all. So it's not a bad thing if people, like you say, have sponsors. Listen, car racing have sponsors. Golfers have sponsors. It's the way some people can, in order to do what they want to do. Paid spokesmen are on all the time for products and so forth and so on. It all comes down to the integrity which you feel you can judge whether or not that person's integrity can be bought or not. I've always argued, despite a few trolls over the years, that no one can buy my integrity. So please God, it'll continue for whatever time I have left on this earth.
Yeah, I agree with that statement. Thank you so much for once again stopping by the show, and definitely looking forward to have you on again in the future to continue the conversation.
And if you want to fly me out so I can see where my grandfather was from, the island of Silber in Croatia, I'll be glad to come out.
Oh, I would love to see you in Croatia. That would be amazing. Thank you so much, Peter, and you have a great day.
Thank you. God bless.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.